Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we are going to learn a concept which is additional paid-in capital on the balance sheet end. Now what we have over here is the extract part from the balance sheet. As you can see, there's a shareholders equity under which you have common stock, then you have additional paid-in capital, retained earnings, and so on and so forth. It goes on. But the most important thing that we are here to understand is the additional paid capital. What exactly this is all about, that let's understand this. The very initial end, additional paid-in capital is basically, the amount that is excess. It is the excess of the par value, and it is listed on the balance sheet. So if we deduct the par value from the issue price that is listed on the balance sheet, we'll get the additional paid-in capital. Now, there's a thing called par value of stock. So the par value of the stock is the minimum amount that must be paid to own a share. Now, it means that, to acquire a share, this is the base amount that has to be paid. Like, for example, if a share is issued at, let's say, $50 per share, and it has a par value of $5. It is issued and it has par value standing at 5. Now, we will conclude that, this $5 per share is the minimum amount that must be paid to acquire the share. So the base amount is also called as the legal, right over here, legal capital of the company. Here, the APIC, that is the additional paid-in capital, comes in, and since each investors of the company, they pay the whole amount, that is they pay the issue price to acquire one share. Anything above the par value is APIC. From now onwards, I'm going to talk as API. Therefore, the additional paid-in capital formula is going to be something like this. The issue price minus the par value is into the number of shares issued. That will give us additional paid-in capital. Now, there's another thing that you need to consider while calculating the additional paid-in capital. If the shares are purchased from the company during, let's say, the IPO, let's say FPO, directly, then there would be an APIC above the par. What am I saying? The APIC will be above. It will be greater than the par value. Now, however, if the shares are purchased from the secondary market, let's say we say that, these shares are purchased from the secondary market, then what exactly will go about in that particular scenario? It would not affect the APIC of the company at all. So let's understand this with an example. Let's take an example to understand the APIC on the balance sheet better. Let's say there is a company called Infinite Inc. and it has issued the equity shares that is standing at 10,000 at $50 per share. Now the par value of each share is, let's say, standing at $1 per share. What we need to do, we need to find the APIC. This is an easy to understand example that can, illustrate how to approach the additional paid capital on the balance sheet. So cash proceeds, first thing that is going to be the cash proceeds that you are going to receive is how much? It's going to be 50 into 10,000, right? Then you will be having a thing called common stock. So your common stock is going to be 1, that is your par value, into 10,000. So that's going to be in total 10,000 as a part of your common stock. And the additional paid-in capital is going to be is equal to bracket 50 minus 1 into number of shares. So C4, perfect. There's 4,90,000. So Infinite Inc. has issued 10,000 equity shares at 50 each, and that means the total equity capital would be 10,000 into 10. I'm talking about the total equity capital that is going to be is equal to 10,000 into 10. That's going to be $1 lakh. If the shares are standing at, let's say, 50 per share, that means the total equity share capital will be 10,000 into, right? So the catch is the par value, which is just $1. And that means that we need to attribute the respective amount to par value stock. So here the par value would be 10,000 to 1. 10,000 into 1. So that's going to be $10,000. And the rest would be the additional paid-in capital on the balance sheet, because as it is over and above the par value, that means the additional paid-in capital formula will be as simple. It's going to be 50 minus 1 divided by the number of shares. So then the total APIC in this scenario is going to be 10,000 into 49. right? So that's 4,90,000. That's what we evaluated. Now, there are going to be some journal entries that will go about with additional paid-in capital. Now, how would we pass the accounting entry for the additional paid-in capital on balance sheet? See, first of all, we need to think that, about the legal capital, that is, the par value stock amount. Now, since that's the legal capital, we attribute the amount to the common stock account. So the rest of the amount, that is the issue price less the value per share, would be attributed to APIC, right? So the entry would be first cash account would be debited because that's the amount you are receiving, since cash is an asset, and by receiving the whole amount, that is the total equity capital, the company's assets cash is increasing. Second, we would do what? We will credit the common stock. We'll credit the common stock account and the APIC account in their respective portion. Right now, I hope you have got a clear idea regarding the example part, journal entry part. Now, I'm going to explain you the reasons for the changes in the additional capital. What are the reasons that leads to changes in the additional paid-in capital in the balance sheet? Now, if you see over here, this is the Colgate's example. This is a Colgate's extract. This is a snapshot of the additional paid-in capital on the balance sheet, and we note that the APIC has been changing each year. Now, we note that the changes in the APIC of the Colgate is due to three reasons. First, the share-based compensation expenses is 127 million. The shares issued for stock option is 197, and the share issued for the restricted stock awards is -34. So the share-based compensation expense is reported in the income statement, and this results in the lowering the net income and thereby reducing the shareholders' equity through retained earnings. So the contra entry for this would be assets is equal to liability plus shareholders' equity. Assets is equal to your liability plus your shareholders' equity. And your share, in the case of shareholders' equity, there will be increase in the paid-in capital. There will be increase in the paid-in capital, and the owner's equity will reduce. So this is going to be the impact. So on a conclusion note, additional paid-in capital on the balance sheet has nothing to do with the market price of the share, nothing to do with, and it is completely dependent on the issue price. Now, if an investor purchases the share from the company and it sells off to another investor at a higher price, it would not affect the capital of the company. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.